KOSPI 6763. The signal downgrade is activated. All right, let's get right to it. The sell-off you saw in SEOUL, that's not just random noise. It's a mechanical repricing of AI risk. And what that means for us is it's a direct lead signal for the US Open. 1.88 trillion Korean won. That's the shock number. That's the amount of foreign capital that just walked out the door. We're going to break down exactly what that means right now. So to understand what's happening, you have to understand the framework. We're running a signal grade downgrade. We're looking at what we call the architecture of cost. Now, let's be really clear about what this is. A signal grade downgrade isn't panic selling. It's a forced price decline. It's driven by rising costs in the system. Think rising yields, think rising energy prices, and that forces a mechanical rebalancing of high beta assets. The story, the fundamental outlook hasn't actually changed, but the cost to hold that risk, that has. And here is that architecture of cost. You've got three macro triggers all firing at once. The US 10-year yield is hitting a critical 4.261%. WTI crude is at $96.4 a barrel. And the USD/KRW exchange rate just broke 1501.5. Every single one of these adds friction. It makes holding risk more expensive.
So was this just some passive selling, simple deleveraging? Absolutely not. The data shows this was active, deliberate positioning. We didn't just see prices go down, we saw an expansion in short volume. That's high conviction. The signal is confirmed.
So where did the smart money focus this pressure? Right on the most important supply chain nodes for AI. We're talking Samsung, down 3.84%, and the memory chip giant SK Hynix, down 4.07%. Together, they led the short selling with a combined 582.4 billion Korean won. This wasn't a broad market sell-off. It was a surgical strike on the tech supply chain. And this brings us to our core directive. Do not trade the headline. Trade the supply chain. This is where we pivot from analysis to our battle plan. All right, attention. We are now shifting to the US execution vector. Our proxy is NVDA. The analysis phase is complete. We are now in command mode. Here's the sequence of operations. It's a three-step protocol. Step 1, watch the pivot level on Nvidia. Step 2, wait for the 10-year yield to confirm the pressure. Step 3, execute based on the precise conditions I'm about to give you. Decision box 1, entry. The criteria for any bullish position are strict. You will only enter a scalp long if Nvidia breaks above its pivot and the US 10-year yield falls below 4.2%. Both conditions must be met, no exceptions. Decision box 2, bias. Maintain the short bias. If Nvidia breaks below its pivot level, the bearish signal from the Asian close is confirmed. It's validated for the US session. Decision box 3, invalidation. This is the kill switch. You will terminate all long positions if the US 10-year yield remains above that critical 4.26% threshold and the Nasdaq breaks key support. That would confirm a global, synchronized de-risking event. Okay, final check. We need to shift focus for a moment to the US data catalysts. These are what will dictate the volatility for the rest of the session. We've got three high-impact events on the radar. At 8:30 a.m. Eastern, you have initial jobless claims and housing data dropping simultaneously. Then, after the close, FedEx earnings will give us a real pulse on the broader economy. Expect turbulence around these releases. So, after all that, what is the key lesson here? What did we just witness? Was it some kind of predictive signal, or was it just a mechanical reaction? And the answer is crystal clear. It's a mechanical cost absorption event. The market is just recalibrating its valuation grade because the cost of holding risk has gone up, plain and simple. And the beauty of it is, it gives us a 12-hour head start on how US tech is going to price in these exact same conditions. Log the result at 0630 EST, no exceptions.